Welcome to Kitco News. I'm Niels Christensen. Lockdown measures are starting to ease around the world. Investor sentiment is improving as equities appear to be holding on to their gains from the March lows. Here to talk about his investment opportunities that he's watching is Robert Duncan, Senior Vice President and Portfolio Manager at Forstrong Global. Thank you very much, Rob, for joining us today.
Yeah, thanks for having us, Niels.
So let's just jump right into this. What are your thoughts on market conditions and potential economic recovery that we're looking at?
Yeah, so I think it's a great question. It's what's on everyone's mind right now. A bit of a loaded question. I think in order to answer it correctly, I've got to go back in time a little bit. Sort of a take two here. But if you asked us this question back in March, we would have given you a much different response than I'd be giving you today. So looking back in March, we actually became very bullish, which was kind of contrarian to what we were seeing. And our investment team actually sat down and kind of delayed our rebalance, and in addition to adding risk in the portfolio, to watch and see what the policy response was going to be to try and support and mitigate the damage from the COVID pandemic. And I think it was in March 23rd or 24th where we not only rebalanced the portfolios, but we added risk. So we reduced our cash, we sold some fixed income, and we bought equities around the world to participate from what we saw at that point in time was going to be a V-shaped recovery. And we saw it for a couple of reasons. Now, there's a lot of debate right now whether this is going to look like a V, a U, or a W. And as mentioned, I think right now, my response is going to be different to that question. But back in March, we definitely thought it was going to be a V-shaped recovery for three reasons. I mean, one, we knew that the impact was going to be substantial, but we thought it was going to be transitory in nature. Two, the policy response from both the governments as well as Federal Reserves was unprecedented in its size and its time to deployment. And then three, it happened to do with a lot of panic selling. And we do incorporate a fair amount of investor behavior and psychological behavior as part of our investment process. And not to say that we're contrarian by nature, but our view is that a lot of the panic selling had driven assets to disconnect from their intrinsic value. And for us to keep our calm and composure and to stop people from making these big mistakes by selling into panic, we were able to capitalize on that and actually really help our portfolios recover. So to finish answering this long question, fast forward to today, we've already kind of had that V-shaped recovery. And we do think that there's opportunity for this market to continue to run. But from our perspective, we are being a little bit more on the defensive side. So we have raised cash in the portfolios. And we've certainly pivoted a few of our equity exposures to more high quality countries. So countries that have handled the COVID crisis quite well and kind of come out kind of ahead of other countries that have had very, very large numbers and large shocks. And then from that perspective, we do expect volatility to present itself as we recover. But again, I think that's kind of the benefits of why you have a globally diversified portfolio so that you can prepare for some of these outcomes, because there are a lot of uncertainties that you need to be aware of.
So to put your feet to the fire a little bit, what countries do you like right now? What investment opportunities do you see sort of going forward?
Yeah, I can give you two countries, and one of them kind of seems like an obvious answer. The other one probably less obvious, and both of them are in the news today. So we were underweight U.S. equities broadly heading into the COVID pandemic, which we kind of missed. It hurt us a little bit because we missed that final late stage bull market rally, which led into it. But it really helped us because the U.S. was one of the most impacted markets during this. And in March, we saw this as a grand opportunity to basically help the portfolios get back to neutral. And a lot of that had to do with the size of the response. Now, clearly, the U.S. government Federal Reserve was the fastest to respond with the largest stimulus package in the world. And clearly, when you present that, it's going to have a great response from markets because investors kind of see government wiping away downside risk within equity markets or global markets. And you start to see the government's investing, you see larger pensions investing, and you get the retail money coming in. So it's been a huge boost in the portfolio. Now, the other part of that story, I would say more on emerging Asia. So we do have a bit of a love affair with China. And we look and we understand that China was the epicenter or the start for the COVID virus. But their response and their recovery has actually been quite sound. And we do see great opportunities within that region to invest. particularly within Chinese technology, which continues to do very well. It's actually one of our better performers year to date. So again, those are very polarizing positions to have in a portfolio. But from our view, we think there are opportunities within both, and actually the merging of those two risky assets actually creates a less risky portfolio overall. So that would be my view on those two.
So you said earlier that you're taking more defensive position right now. You've raised cash. How does gold fit into your portfolio?
Yeah, so we always look at gold as an asset class that we would use for more defensive hedging purposes or even inflation hedging purposes. So I think the last time that we spoke, I was talking about global gold miners. So GDX would be an exposure that we have used in the past. And this is something that we had in the portfolio throughout the pandemic, and then more recently actually increased that position, which has done quite well for us overall. When we looked at gold in the portfolio, clearly there was a bias to the physical, but looking at what had transpired in equity markets and the panic selling, we saw there was a massive disconnect. Again, not to use the word twice, but a huge disconnect in terms of intrinsic value. And there was a greater opportunity for a play on senior producers within the gold sector than it was to play on the value of physical gold itself. So that's how we would be playing it. We've increased it, and it's done quite well for us so far this year.
Do you think more attention is going to be put on senior producers? I mean, we sort of look at major companies cutting back dividends, and yet the mining sector is actually increasing their dividends. And I'm sort of wondering how does that play into the investment psyche?
And that's a great question. Definitely, there's a lot of sectors that have been heavily hit, and clearly they would be reducing dividends. I mean, I really don't see senior producers as the best dividend play. I mean, from my view, I look at more quality exposures, whether it be utilities, REITs, or even financials that would pay quality dividends. From my perspective or from our perspective, this is a true asset class play, and I'd say a higher beta gold play than just physical gold itself. So while I'm sure it's good for the sector overall and would be supporting our senior producers positioning, it's not something that we totally track, but it's definitely something to be aware of for sure.
And I just wanted to go back to your comments. I think really appropriate. I mean, the government is really backstopping this equity market. I mean, do you think they have more ammunition? What are your thoughts on sort of the amount of liquidity that has flooded financial markets?
It's amazing. I mean, if you have access to the data and see the numbers, it's unprecedented. I've used this word before, and it really is incredible. I mean, I think one of the reports I saw, when you aggregate all countries around the world, all central banks around the world, and put together the stimulus packages, it equates to almost 25% of global GDP, which this has never been done before. So it's absolutely incredible. And people ask and talk about. I mean, we can certainly see some of the policies that have been put in place within Canada, and we see what Trudeau's doing, and they talk about their 40 or 50 billion dollar aid packages, and that's a big number for Canada. But when you look at what the U.S. is doing with 2.2 or 2.4 trillion, it's not even close. It completely pales in comparison. And there's a lot of people that talk about that this is going to be temporary aid, and it reminds me of a quote from Milton Friedman, actually, that we've used a few times. And there's nothing more permanent than temporary policy responses.
Are you concerned about the long-term implications of this unprecedented reaction to the COVID pandemic? How do you position your portfolios, sort of long-term? Are you looking 10 years, 20 years down the road?
This is a really good tee-up question. We are in the midst of writing a response, and I guess you can call it a white paper response to investing in a post-pandemic environment. And there's going to be many facets that we're going to touch on. Now, every year we write a report called Super Trends. These are Forstrong Super Trends. And when we invest, one of the key pillars is our macro super trends and thoughts. And it can be anything from one of them that we still believe in and have always believed in was oil prices lower for longer, interest rates lower for longer, the Japanification of U.S. equity markets, the demographic shifts, the emerging market consumers. And this new one is going to be the digital age. So there's kind of two ways to look at it. There's going to be responses or how we expect people to respond. So again, behavior and psychology. And then I think there's going to be the investment or asset class responses. So I'll start with the investment side first, and how this bleeds into our views. So we think that there's going to be a complete oversupply of government bonds for the next several years, which is going to keep yields depressed. So from that perspective, in order to try and get an adequate sense of yield, we're going to have to look outside borders and find exposures that are going to help give us that yield, but still also offer quality. So again, we do have a view that some higher quality U.S. corporates are sufficient, and even some emerging market debt is also quite sufficient to be added to a portfolio. But when you look at the personal touches for the people, like the work from home movement is, you cannot deny this right now. I mean, you without naming single stocks, I mean, you've seen these companies go up 4, 5, 6 fold in the last 3 months because of this work from home movement, this digital age. And we do, within all of our portfolios, we do have a tilt to technology, and in particular, a tilt to global technology. So we are benefiting from this, but we're trying to do more and spend more time thinking about the longer term ramifications and what this is going to look like. And this is, to quote one of my favorite investors, Howard Marks, like, this is second order thinking. Like, don't just think about the immediate move. Those are the tech companies. Think about the longer term impacts. Think about how the impact this is going to have on commercial real estate, the impact this is going to have on automobiles, the impact it's going to have on everything. So again, that's what we're trying to decipher.
Yeah, I was going to say commercial real estate has got to be suffering, with everybody working from home. You could see offices just, cut back and shut down and move everything, on into the cloud.
We're a very mobile company. We were able to transport everyone from the office to working remotely in 2 days, and we were fully operational in 2 days. So it was, I mean, we're a rare breed. We are a smaller firm, but about a dozen of us. We've all got laptops. Everyone pulled all their monitors home, and we were able to get set up and run. But again, like, we were definitely using cloud services. And then even from, talking about the work from home movement, I think about, again, I keep going back to the psychology and behavior of it. Think about people that have struggled to work in large offices that have now seen the benefits to their lifestyle, their health from working from home. Like, you're not going to get those people back to the offices. And even from me, we were kind of playing with each other about some of the joys of working from home. I've got 2 young boys, 1 and 3, and while it's been an absolute challenge working from home with them, it's been amazing to see them more. And I think going forward, I'm going to be working from home more than I have in the past. I think everyone will. So it's going to be interesting to see how this shakes out longer term.
Fantastic thoughts, Robert. Thank you very much for this conversation. I've very much enjoyed it.
Likewise, Niels. Thanks so much for having me on here.
Perfect. Thank you for watching Kitco News. For the latest information in the precious metals markets, go to kitco.com. Stay safe and stay healthy.